Let's take a look at our final case study here. Question 13, Journey Through the Maze. The same way we did in our final prep case study, as we applied the line items for this limited top sheet budget to the budget, we're doing the same steps here. We are applying the numbers, the allocated line items for story rights, writing, development, producers and staff, director and staff, talent, to the limited top sheet budget to arrive at the total above the line. We're adding the production staff, camera, set, construction, locations, and other production period allowances to get to the shooting period amount. Then we're adding the post-production items for the editing, the film post, which is color correction, sound correction, any visual effects or music budget, and other post-production allowances to arrive to the total post-production line item number. And then we have some other general expenses, legal fees, and some indirect costs and financing fees that will be added, and we get to the total of other accounts. We then have the above the line and below the line automatically populated. If you're using the Excel spreadsheet that's been provided for the final case prep study, you can use the same one here. And then you get the subtotal, which then allocates the financing amount. And then you get the subtotal for the budget to then allocate the contingency and the completion bond amount. All of this is populated automatically if you use the Excel. Therefore, you have the completion bond insurance fee of 2% included in the budget, as well as the contingency of 5%. And the exclusions that we have listed here for the rights, the writer, the development, the producer and staff, and the legal line items will automatically have been excluded from the calculation of the bond company insurance fee if you use the Excel spreadsheet I've sent you as a template. If you don't, just make sure that you exclude these line items so you have the correct budgeted amount to then apply the completion bond insurance fee of 2% to that. As we always do, we always in the first steps figure out what our distribution assumptions would look like. So we're looking at international sales estimates, and we're looking at US projections, and we're looking at pre-sales and so forth. So the US release we're going to start with here. You can also do that at a later time when you do your recoupment schedule, but you can do it right now. And let's go through this. The assumptions are telling us we're making $20 million in the box office. The exhibitor, the theater owner, will be receiving 45% of those box office ticket sales. So we need to deduct 45% of 20 million, which is 9 million. So we're then left with 11 million, and that is the amount that the studio would receive, for which they, in this case Warner Brothers, charge us a distribution fee of 25%. 25% of 11 million is 2,750,000. So we are left with 8,250,000, from which we then have to deduct all our P&A costs and expenses, because this is a rented studio deal. We rent Warner Brothers to release the film for us, so we have to raise the P&A investment ourselves to pay for the release campaign. And here we are doing a very specified release, which only costs $1,500 per screen. Normally this is much higher, but we're doing a targeted release for this movie. So our per screen price of $1,500 for 1,500 screens will come to $2,250,000 in P&A and P&A costs and in P&A investment. The P&A fee payable to the P&A investor is 12.5%. That is $281,250. So altogether, we pay the P&A investment back $2,531,250,000. So we're left with, after we're deducting all those fees, a net US revenue of $5,718,750. So let's look at our international sales estimates and our pre-sales. Our international sales are estimated to be 80% of the budget, which was $13,758,740, and that will get us 11,06992 for the estimates to be receiving from international distribution rights revenues. Now, next step, we are now actually doing some sales. We're entering into some pre-sales and sell some of these distribution rights before the movie is finished. In this particular example, we're selling license rights to Germany, Italy, the UK, France, India, and China. So altogether, our subtotal for Tier 1, meaning Germany, Italy, UK, and France, is 4,677,971.60. Each of those distributors have a payment plan in their distribution agreement, and they each pay us a different down payment amount. The German distributor pays 20% upfront, 80% on delivery of the film. The Italian pays 15%, UK 20%, and France 20%. So altogether, our down payment amount for the Tier 1 territories is 887,438.73. So that's the first money we will be receiving from these distributors that have pre-bought the distribution rights to our film. For Tier 2 territories, China and India, we get 10% for the down payment in relation to the license fee, which is a total of 13,758.74 cents. And the subtotal for India and China Tier 2 territories that we have entered into with pre-sales is 137,587.40. Now the Tier 2 and Tier 1 total is 4,815,559. So the total down payment due to us at this point would be 901,197.47 cents, but the sales agent is charging us 6% on this because they did the job in making the pre-sales happen, and they want to be paid when we receive the down payment. 6% of 901,197.47 cents is 54,071.85 cents. So what we have available for funding at this moment to cover a portion of our budget is going to be 847,125.62 cents. The pre-sales we have established, as well as the rights we still have available after selling the pre-sales, are worth money to the bank. So first, we're going to take all our Tier 1 and Tier 2 territory contracts, our pre-sale contracts, to the bank, and they will give us a loan. The bank will cash loan 93% of our Tier 1 territory contracts and 60% of our Tier 2 territory contracts. So altogether, they will cash flow 4,433,066.03 cents. So that is going to be the pre-sale loan. We have to then deduct the down payment that we already received, which was 901,197.47 cents, and you're deducting the gross amount here, not the net amount that you receive, because the bank doesn't care that you have to pay the sales agent. They want to know what was already paid on the contracts, what was paid on this pre-sale agreement, and what is left to be collected when the movie is being delivered. So the gross pre-sale loan then comes to 3,531,868.56. So we have to pay 4% interest per year. The term for this loan was 2 years, so this is 8%. The interest reserve will therefore be 8% of 3,531,868.56 cents. So we're paying interest of 282,259.48 cents. So the net pre-sale loan will come to 3,249,319.07 cents. This is money that we can use. In order to figure out our gap loan, we have to first figure out how many unsold right territories do we have left, because that is the collateral for the gap loan. The lender will look at the unsold rights by looking at the entire sales estimates and deducting the pre-sales. And that number gets us 6,191,433 in unsold rights. The bank will only ever give us 50% of that. However, the budget cap for the bank is going to be 20% of the budget. 20% of our budget is $2,751,748, and that is less than what the collateral assumption amount would have been. So that is the amount the bank will give us, and not a cent more. We are paying interest 6% per year. For 2 years, that is 12%. So 12% of the gross gap loan amount of $2,751,748 is $330,209.76. The net gap loan amount is $2,421,538.24. That is the amount we have available to cover our budget. Now the assumptions are also talking about loan fees and legal fees and some other fees that we have here. In this case, altogether we have $90,000 worth of additional loan fees, which we have to deduct from the gross loan amount, which leaves us with $5,580,857.31 for the loan from the senior lender, or the bank in that case, to be used to cover a portion of our budget. The junior lender in our assumptions gives us 15% of our actual production cost, which is our budget minus the in-kind services, which were $440,000. So the strike price is $13,318,740 for the budget, and of that the lender will give us 15%, which is $1,997,811. The interest due for this loan is 5%, so we have to deduct $99,890.55, leaving us with the mezzanine net loan of $1,897,920.45. So the crowdfunding was 5% of the actual budget, which is $687,937. The commission due to the crowdfunder is 25% of that, and we also used $20,000 from the crowdfunded amount as development costs, which we have to deduct because we don't have those anymore and cannot use that to cover the budget. So we're left with $495,952.75 from the crowdfunding amount to cover a portion of our budget. Mercedes decided to support our movie with $650,000 sponsorship. The agency that did the deal for us charges 25% of that, which is $162,500. The sponsorship due to us at this time is 50%, which is $243,750, and the other 50% will be paid to us at a later time when the movie is finished. The production incentive Georgia offers us is driven by the below-the-line amount of our budget, which was $7,695,000. That is the only eligible expense Georgia will allow. So of that, Georgia agrees to give us 35%, which is $2,693,250. So that's an assumption based on our budget. In order to get this from a lender, which we would like to do because we would like to get the money in advance and not produce a movie first to then get the incentive paid to us by Georgia, we need to do a deal with the lender. That lender charges us a 10% fee. The lender is 120 dB, and they charge us a legal fee of $15,000. So all this is deducted from our production incentive amount Georgia provides to us. So we are left with a net production incentive that we can use for the budget in advance of $2,408,925. These two in-kind service / deferment options will not be added to our budget because these budgeted line items are being deferred and will be paid in the recoupment schedule. We have visual effects of $320,000 and music budget of $120,000. Both of which is deferred. This is not a music investment. This is simply the budget for music, which is why this is a deferment and not a music investment, just to remember this. So $440,000 are being deferred, and they're also being deducted from the budget because they're being deferred, meaning deferred from having to be paid at the production time, at the time of us shooting the movie. So again, we're paying this deferred $440,000 later in our recoupment schedule. In order to get to our equity investment, we are summing up all the investments and loans and monies we have received so far, which gets us to a subtotal of 11,474,531.14. And in order to hit our strike price, which is the cost we have to produce the film, we need to figure out what our equity is. So the strike price is 13,318,740, as we mentioned earlier. So we will need equity of 1,844,208.86 to reach the strike price to be able to make our movie. So let's take a look at our finance plan altogether again here, just for the pre-sale section and the senior loan. So again, the budget was 13,758,740. We are deducting the deferments for visual effects and music, which were 440,000, which gets us a strike price of 13,318,740. Now for the sales estimates, we go by the entire budget. We're not going by the strike price. 80% of the budget, 13,758,740, is 11,609,992. So this is an assumption. This is what we believe we can generate through distribution revenues from international, non-US, international territories. Now in the next steps, we are selling some of these international territories now. So these are actual contracts that we're entering into in form of pre-sale agreements. We're selling Germany, Italy, UK, and France distribution rights for a total of 4,667,971. And we're selling India and China for a total of 137,587. So we're getting a total of 4,815,559 in pre-sales from the Tier 1 and Tier 2 territories we just sold. Each of the territories are giving us their down payment anywhere between 10 and 20%. So altogether, the down payment that we're getting as a prepayment, as an advance payment from these distributors is 901,197.47. The sales agent would like to be paid for generating these agreements, and the 6% due to him would be 54,071.85, leaving us with 847,125.62 that we now have available to use for the movie. In the next step, we are doing our pre-sale loan. And here we're looking at the Tier 1 and Tier 2 territory, both of which are discounted when the bank gives us a loan for those pre-sale contracts. Tier 1 territories will be 93%, and Tier 2 territories will be 60% of what we would be receiving from the bank as a loan. So altogether, we get a bank loan for these territories of 4,433.66, but we have to deduct the down payment that we already received for these contracts, this advance payment of 901,197.47, because we already received this portion. So the gross pre-sale loan therefore is 3,531,868.56. The bank charges us 4% per year, deducting its interest, leaving us with a pre-sale net loan of 3,249,319.07. The gap loan is considered by looking at all the rights that are available after we're deducting the pre-sold Tier 1 and Tier 2 territories from the international sales estimates. However, because the bank will assume a cap of 20% of the budget, that is lower than what we would be receiving as a gap loan otherwise. So therefore the cap is applicable here. 2,751,748 is our gross gap loan. The interest of yearly 6% is deducted, leaving us with 2,421,538.24 in a net gap loan amount. The loan fees and legal fees are deducted, leaving us with 5,580,857.31 for our net loan amount. This is the senior loan we will be having available to us to cover a portion of our budget. Let's take a look at all the other finance plan elements. We had a junior loan of 15% of our strike price. We had a crowdfunding amount of 5% of the budget. we had brand integration for Mercedes, we had production incentives against the below the line amount, and we have in-kind services, which we are listing here, but we are not adding to our subtotal because these are deferred items. Sorry. So altogether, we have now collected 11,474,531.14 from these finance sources. In order to meet our strike price of 13,318,740, we are now adding also the equity of 1,844,208.86. Movie is made, the rights are sold, all the distribution revenues are coming in, and we now can start our recoupment plan. So money is coming in from international. Remember, we had international sales estimated at 11,609,992, which we actually generate. We have to obviously deduct the down payment because we received it and used it for the budget. So we're left with international sales revenues of 10,105,794.53. The US, we have a box office of 20 million, 45% paid to the exhibitor. The studio charges its fee on the balance. If we deduct all these costs, we have an adjusted gross revenue of 8,250,000. We need to then pay our P&A investment of 2,531,250, leaving us with the US of 5,718,750, and together with the international revenues, we get to worldwide distribution revenues of 15,824,544.53. The brand integration, the second payment, is now due. So we are adding 243,750 and getting to total revenues of 16,086,294.53. We have established our revenues, and now we need to deduct our expenses. So let's define them. The collection agent is going to charge us 1% of the amount that has been paid into the collection account, which was 16,068,294.53. So 1% of that is 160,682.95. They're also charging us a setup fee of 40,000, which gets us to 200,682.95 payable to the collection agent. The bank loan is going to charge its gross loan amount of 6,283,616.56. We have to pay guild residuals of $850,000. Then we are charged the sales agency fee on the unsold international distribution revenues of 16%, 990,629.28. The sales fee on the pre-sales is due, but remember, we already got some of that, so we need to deduct the portion that we paid already on the pre-sale amount. So another 6% is due here, and that is 234,861.69. So altogether, we're paying the sales agent 1,225,490.97. The junior lender loan amount was 1,997,811. The premium for that is 10%, 199,781.10. The executive producer fee due, paid here in the recoupment schedule, is 75,000. So altogether, we're paying the junior lender 2,272,592.10. The equity investment was 1,844,208.86. We have to pay a premium of 20% on that, 368,841.77. So altogether, the equity investor is receiving 2,213,050.68 from our recoupment schedule here. They will also receive a profit participation later. So the deferment for the visual effects and music line item is now paid. So 440,000 goes to them. They asked for a premium of 10%, which adds another 44,000. So altogether, 484,000 is due to the deferred line item providers. Altogether, our expenses are 13,529,433.21. After we established our net revenues by deducting our expenses from our worldwide revenues, including the brand integration, we can start paying our profit participants. We're paying the mezzanine/junior lender 5% of our net revenues. Crowdfunder gets 1%. The talent combined has a 30% profit participation, and the equity investor gets 40%. This is 76% in total for profit participants. 76% of 2,538,861.32 is paid out to these profit participants, leaving 609,326.72 for the producer. So the producer profits, in answer to question 13, would be 609,326.72. I hope this step-by-step guide could help you find the answer to the question 13 in the final, and could also help you finding out where you potentially made some mistakes in your own question answering process. All right, thank you guys. We are done. Final is done. So congratulations on doing such a great job in working out the final. I know it wasn't the easiest, but you're now ready to rock the world of film finance for your own projects.